Ethical challenges. The following is a list of common ethical challenges that professionals in the mortgage lending business face. A personal need to achieve success and the financial pressures to provide security for family or others. Factors related to competition in the industry and in business in general that may lead to a company environment culture that encourages a professional to compromise his ethical values in order to achieve organizational goals, make the sale at all costs. Managers and performance standards, such as quotas that may pressure mortgage loan originators to produce regardless of the methods used to achieve desired results. Methods of compensation, such as commissions, bonuses, or opportunities for profit sharing that encourage sales over service. Lack of company support for ethical behavior, as evidenced by the lack of a company ethics policy, a lack of communication of a company ethics policy, or a lack of ethics training by the company. General confusion among borrowers about how interest rates and points interact. The borrower may overlook higher points and costs added into the loan amount by looking only at the low rate or failing to anticipate the consequences of the lapse of an introductory rate. Unethical demands made by borrowers, such as limited doc or no doc applications, encourage applicants to exaggerate or fabricate income, employment, or asset information. While the mortgage loan originator may earn a fee for processing the application, there is a strong possibility that a loan obtained in such a manner will eventually become a major problem for the borrower who cannot afford it, and for the lender or eventual investor who must deal with a default and foreclosure. For example, after mortgage loan originator Mel Lowe informs Anita Loan that she lacks sufficient income to qualify for the loan she wants, Anita suddenly recalls that she makes double her previously stated income based upon her side business. She later provides Mel with documents supporting the additional income. Mel, although suspicious, does not question Anita about the additional income and submits an application that includes it. After the loan closes, the lender discovers the claimed additional income never existed. Suitability. The results of presenting borrowers with disclosures and expecting them to arrive at beneficial decisions have been somewhat disastrous. Therefore, today a mortgage loan originator must realize that he does have some responsibility, even if not required by statutes, to ensure that he is providing loan programs that are suitable for an applicant. He has a duty to provide advice and service which are in the applicant's best interest. In order to do so, he must make a conscientious effort to ascertain and to understand all relevant circumstances surrounding the client. Before attempting to take a complete loan application, he should evaluate the applicant's qualifications, identify the applicant's personal and financial objectives, align loan programs with the applicant's circumstances, perform financial and home ownership counseling where applicable. To provide ethical customer service, the mortgage loan originator must carefully assess the applicant's needs, educate him about financing alternatives, help solve problems that arise in the loan approval process, and be an advocate for the applicant. While it may be tempting to simply agree with a borrower who has decided he wishes to refinance in order to earn the fees, the mortgage loan originator should only promote the refinance when he is sure the borrower understands all costs and negative aspects, is able to evaluate fully the implications of the new loan, still believes the refinance is the best course of action. Communication. Communication is vital to processing, and lack of communication with the borrower can result in lost business. It is very important to keep the borrower aware of the status of his file. If there is a change in the file that has an adverse effect on the borrower, an adverse action form must be sent to the borrower. Mortgage lending rules, regulations, disclosures, and practices can seem very intimidating and confusing to many potential borrowers. The mortgage loan originator needs to be able to explain the process simply, concisely, and without the use of jargon. He must avoid unnecessary details and focus on what matters to the customer. He should explain briefly how the loan process will work and explain the need for and process of obtaining documentation such as bank statements, tax returns, pay stubs, divorce papers, and verifications of employment and deposits. The borrower should also be reminded that there are no guarantees of approval, additional documentation may be required, the expected date of closing in the sales agreement is really no more than a target date. Providers should strive to focus on information important to consumer decision-making, highlight key information so that it will be noticed, employ a user-friendly and readily navigable format for presenting the information, use plain language with concrete and realistic examples. Consumers should be made aware of balloon payments, when structural payment changes will occur, and what the new payment amount would be or how it would be calculated. Descriptions could indicate that a higher payment may be required at other points in time due to factors such as negative amortization or increases in the interest rate index. Any potential for increases in payment obligations. Monthly statements provided on payment option ARMs should. Monthly statements provided on payment option ARMs should explain each payment option available and its impact on loan balances so the consumer can make informed payment choices. Contain an explanation next to the minimum payment amount that making this payment would result in an increase to the consumer's outstanding loan balance. Disclose the current loan balance, the portion of the previous payment allocated to principal and to interest, and the amount by which the principal balance increased. Providers should avoid the following practices: promoting payment patterns that are structurally unlikely to occur, giving consumers unwarranted assurances or predictions about the future direction of interest rates and, consequently, the borrower's future obligations, making one-sided representations about the cash savings or expanded buying power to be realized from these products in comparison with amortizing mortgages, suggesting that initial minimum payments in a payment option ARM, suggesting that initial minimum payments in a payment option ARM will cover accrued interest charges, making misleading claims that interest rates or payment obligations for these products are fixed, obscuring significant risks to the consumer, for example, a provider advertising or promoting a high-risk mortgage by emphasizing the comparatively lower initial payments should also provide clear and comparably prominent information alerting the consumer to the risks. Such information should explain that these payment amounts will increase, that a balloon payment may be due, and that the loan balance will not decrease and may even increase due to the deferral of interest and/or principal payments.